So in this section, I'm going to talk about stochastic, how we can combine it with the last three strategies or indicators that we just used. And this one is just as simple as the MACD. In fact, we use it exactly the same as the MACD. So before I even go to it, you guys are already pretty knowledgeable about what we're going to do here, but I'll go over it anyway, just so we're 100% sure we're on the same page. So stochastic, it's a momentum indicator that displays overbought and oversold conditions. That sounds familiar, doesn't it? Sounds like the Bollinger Bands, sounds like the RSI, sounds like MACD. Same concept. We just now have four confirmations. If they all line up with each other, suddenly we go, hey, maybe it's not just a random time to buy or sell. Maybe this is actually a good time because all these indicators that professionals use, that banks use, that investors use, that hedge fund traders use, maybe this is a good time to buy. And so you start to see that how Forex really isn't that complicated. It's just a bunch of complicated things, or it's a bunch of simple things put together into something that looks complicated. So here's what stochastic looks like. We can see up in the upper left-hand corner where I say settings. So we can set different speeds. So these are just changing to basically the moving averages of what we're seeing here. The algorithm for stochastic is different than it is for MACD, and it's also different than it is to moving averages. But the baseline is they're simply just moving averages, and you can change the duration of them. So for this strategy, the settings I use are 5, 3, 3. And I'll show you guys how to change the settings in the web analyzer after I explain all of this. So just like with the RSI, anything above 80 is considered overbought, and anything below 20 is considered oversold. Again, you guys probably already know where this is going. So here we can see price is overbought, and we saw the bearish crossover right here, and then price started to sell or started to go down. Now you might be seeing that price didn't do it right after it did it. That's because stochastic, especially with the settings we're using, is more fast active. It's gonna be a little more twitchy. It's gonna give a little more false readings, more fake outs. But that's why we don't use it on its own. That's why we use it with 3, 4 other indicators. But we can see that it crossed over, and then soon after that reversal occurred. So we can see how it still matches up with the rest of them. In fact, stochastic might give us a sneak peek, just like divergence or hidden divergence. Stochastic is the same, where it might be giving us a little sneak peek. Here's another example. We can see price became oversold. We see the bullish crossover, and soon after the bullish crossover, price began to rise. Boom, price went up. So there is a rule to success with stochastics, and that is do not use it on its own. I cannot say that enough. You're not going to find that one indicator that's going to make your trading to the next level. You have to use a combination. Sometimes you don't need a lot. In fact, we're only using 4 different oscillators or 4 different confirmations to do this strategy. But you have to make sure you're using confirmations that line up with each other. And from what you guys just saw, these will line up perfectly. They all display overbought, oversold, so it's really good for a fast-moving strategy. You want to wait for the crossover to complete before entering. So that means if you're looking at a chart and they're about to cross over, they're almost crossing over, that means they haven't crossed over yet. And this actually goes for the MACD as well. You want to wait for the candle to close so you know for sure that the bearish or bullish crossover has completed, because you can get faked out if you do it prematurely, and that's where you take profit, get hit. That's when you start revenge trading. So just keep a level head and be patient. You're not going to have as many losses.